Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Right? A lot of fun things, Ted? Oh yeah, a lot of fun things. I have some bad news. This is very concerning, but it finally happened, and this is something that the elite said could not and would not happen. And yet, they are still remaining in complete denial, despite confirming evidence today that this is now the beginning stages of something that is going to devastate the US economy. And as you're about to see, it's outright terrifying. Because nobody said this would happen, and yet it's about to send a lot of Americans to the unemployment line. So why did I just buy Bitcoin, this ETF? Let me explain. But first, I need you to understand from today's non-farm payroll report, because once you understand, that will make perfect sense of what is coming. As the US payroll growth slows and jobless rate now ticks up to 4.1%, and this is just the beginning of the things the elite said would not happen. Recently, Fed Chair Jerome Powell said the unemployment rate would peak at 4%. Now it's at 4.1%. We're going to make the case of why this headed even higher, but that's not what's really outright terrifying. Let's take a look, because the non-farm payrolls rose by 206,000, and job growth in the prior 2 months was revised down by 111,000. According to the Bureau of Labor Statistics, so already on the forefront, we can put into question the 206,000 number, knowing it's likely going to be revised lower here in the coming months. And we know that it's already based on heavy hiring from the government, because the unemployment rate now rose to 4.1%. As more people entered the labor force and average hourly earnings cooled. This is a dangerous sign, because when you start to see average hourly earnings decline, it simply means there is more labor in the market. Yes, Ted, more labor in the market. You look at supply and demand. There's an oversupply of labor and a lack of demand. That puts downward pressure on wages at a time when most consumers and workers need to see higher wages to keep up with the inflation. And average employment growth over the last 3 months slowed to the least since the start 2021, reflecting a labor market that cooled more in the second quarter than previously estimated. Now keep in mind, if we were supposed to be achieving this soft landing or no landing scenario, this is part of the reason why I bought some ARKB. It's an instrument for us to trade Bitcoin prices. My base case is we are going to have a recession. If that's true, then Bitcoin will crash. However, based on the setup, Bitcoin is due for a bounce. It might be a short-term bounce. We will see. We should have seen the unemployment rate plateau, but we're seeing it rise more than what everybody is expecting. This is just a trend in the wrong direction, but the data are consistent with other reports showing a sharp decline in job openings. But the data are consistent with other reports showing a sharp decline in job openings this year, and a growing number of people filing for unemployment benefits. That is one of the biggest red flags in the market right now. We have oversupply of labor against a lack of demand as we look at continued unemployment claims shown in blue against average hourly earnings of production. And non-supervisor employees, we can see throughout history that as more people get on the unemployment line and stay on the unemployment line, oh, that's not good, right, Ted? Unemployment line, no, it's not good. Unemployment. Well, that puts downward pressure on average hourly earnings. This is something the government has highlighted and seeing, look, we're giving workers, or at least encouraging employers, to provide ample pay growth to keep up with inflation. But based on the continuing uptick in continued claims, it says there's going to be further downward pressure on average hourly earnings. And if you note, the two of those tend to coincide with each other right at inflection point or out of recession. So you start to see the danger here for the US economy that's coming in the summer. This is very unusual because they sustained slowdown and hiring combined with the recent moderation inflation bolsters bets that the Fed policy makers will lower interest rates hopefully as soon as September. The jobs report is to last before Fed officials meet later this month. And we already know that the likelihood that the Fed's going to cut this month is fairly low, unless something changes. But even the media now was starting to get behind the notion there's going to be a cut in September.
So, September?
And think about this, if we were indeed going to achieve this soft landing or no landing scenario, then what we would hear is the economy is about to rebound. There's no reason for a Fed cut, but now you're starting to hear more and more people start to realize the trajectory of the US economy is not going the way the central policymakers want. And as we look at inflation, we can pretty much predict it's going to continue to head lower. Because when we look at total compensation, we now take average hourly earnings and multiply them by average weekly hours of production of non-supervisory employees. We put that red on a year-over-year rate change against the consumer price index, and we see a further slowdown here. That means it's going to put a ceiling on where inflation can go. The worst part is we have seen oil prices rise, and we know gas prices are rising as well. And that is putting a dent into consumer pocketbooks, suggesting inflation indeed is coming down between now and September. Perhaps giving the Fed all the information and data they need to cut rates, but they're still in denial. The downward revisions to the previous 2 months combined with a rise in the unemployment rate are significant data points. And one of the challenges right now is investors make their decision and policymakers on these headlines numbers, and they tend to get revised significantly lower. Yet today we see, of course, Wall Street driving stocks to new all-time highs under the belief the economy is strong. But perhaps they find out soon enough, as the labor market is in far worse shape than they think. And this is what's changing here, because we have some new data that really puts into question where the US economy is going in terms of the soft landing scenario. Because what it suggests, as you're about to see, is we're headed into an all-out recession. I think Bitcoin is telling us more truth than the stock market right now. The numbers may shift the Fed's perception of the balance of risk as unemployment increases against a backdrop of moderating inflation. Minutes from the central bank's June meeting showed a growing concern. This is important, that a further slowing in the economy will result in a higher jobless rate. Well, that's exactly what happens, because employers don't keep workers around if they have no work for them to do. According to the SOM rule, a recession is underway if the 3-month moving average of the national unemployment rate rises by 0.5 percentage point or more. Relative as low in the previous 12 months, with the June 2024 U3 rate of 4.1%, the average of the last 3 months being 4 and the lowest being 3.5%. The SOM rules criteria has been met, which means, as I've been saying, if people are losing their jobs and going on unemployment and are unable to find work, no, Ted, they can't find any work. That's sad, right? Oh yeah, that's so sad. Because other people are on unemployment and can't find work, they stop spending money. Look at Nike, look at Lulu, and Starbucks. When the chicks stop shopping, watch out. And the next thing you know, more people lose their jobs, and the Fed will cut rates, and we will get a recession, crash in the stock market. As you can see, we're now in the beginning stages of what will be an all-out financial crisis. They stop shopping, the chicks. Oh, that's good, he says. No, it's not good. That means we're in a recession. Chicks love to spend. He's saying he's gonna save money this way. Yeah, but it's a recession, Ted. The chick stopped spending his money. Oh, Ted, you're so cute. Oh, you're looking at the ocean, Ted? You're supposed to be on camera. The ocean is better? Oh, he's looking at the ocean. You're a crazy bear.